Okay, here we go. We're going to start as always with the S&P chart. You can see 2 weeks ago we noticed that we had a breakout of our downward trending chart in the S&P. And we started in an uptrend. You can see we have higher highs and higher lows. And we are at the top right now of the channel, the new channel that we're forming, going up. So we expect, we are actually extremely overbought right now. So we have a situation where we're overextended, we're in a bear market rally, this is called, and we are nearing the 100-day moving average. So the moving averages are very important because if we get above the 200-day moving average for the S&P, that's a good indication we have momentum. But in the meantime, we are in a bear market rally. We expect lower highs and lower lows, and we have a contra trend rally. So right now we're at the top of our channel. We expect either to break out. We have a 10% chance of breaking out and going up, 10% chance of going down to here, and we have a 80% chance we're going to continue this uptrend in this new uptrending channel. So let's see what happens next week. Because we're overextended and we're overbought, there's a very good chance that we're going to be going down and into an oversold condition, primarily because at this time of the year, we're done with earnings. We had excellent earnings from the big tech stocks this week. We expected a really good week because this is one of the biggest weeks of earnings season for the S&P 500 and for big tech stocks. And in the past, big tech such as Microsoft, Amazon, Apple, and Google have been leaders in the market, and they've been, so far this year, leaders on the downside. This year, this week, the big tech stocks have shown, in one word, resilience. We have an article from MarketWatch. Apple's earnings can be summed up in one word, and that is resilient. And that means that even with all the macro problems, with a war going on and inflation and the Fed raising interest rates, Apple still performed and had really good earnings, and they gave good understanding that their earnings will be growing in the next quarter. And so that was, they don't give guidance, Apple, but Microsoft and Google and Amazon all had really good earnings reports this week. And it showed that there is a case for buying and holding what's known as compounding stocks. Stocks that compound are ones that you can buy and you can hold, and they will grow over time. Now, there's a lot of people making money in stocks that go up for a little bit and they fizzle out. And for me, I bought Google in 2007 and 2008 during the crash. I bought Apple in 2010, and some of my earliest buys were CSX. These are stocks that once you buy them and you hold them, they'll grow, and you don't have to pay taxes on the growth until you sell the stocks. So what I'm going to do for you right now is a really good time to start accumulating these compounding stocks. Now, how do you know what a compounding stock is? A very good indication is you look at the top 10 holdings in some of the biggest mutual funds. A buy and hold stock, what is a long-term compounder? It's a buy and hold stock that steadily grows. You try to buy small amounts in bad times and when they're out of favor. Right now, most of the top 10 holdings in a majority of growth mutual funds are down 10, 20, mostly 30% for the year. And it's a good time if you're interested in buying and holding for the long term. This is a good time to start accumulating them. What I'm going to show you right here is Fidelity Magellan's top 10 holdings. They're one of the largest mutual funds in the country. Their top 10: Microsoft, Apple, Amazon, Meta, Alphabet, Nvidia, United Health, Home Depot, Netflix. Now, I'd say 70 or 80% of their top 10 holdings is the same going back 10, 20 years. And the reason why that's important, the mutual fund companies, they have unlimited research possibilities. They can talk to CEOs of companies, and they can hire the smartest people in the world to research what to buy. And if these are the ones that they buy and hold, we have to pay attention when they go down 30%, because that could be something that could be a long-term hold in your portfolio. Here's another fund. It's a different company, American Century. It's a really large fund. Their top holdings: Microsoft, Apple, Alphabet, Amazon, Visa, Nvidia, Tesla, Home Depot, UPS, and United Health. And so in every quarter, every 3 months, every quarter, we go back and see, has there been any changes to these top 10 holdings? If there are changes, then we want to see and find out why, or that gives us conviction to keep holding some of these long-term compounders that you might be in your portfolio. Now, one approach to investing that you could take is you could make some money, in short-term buying and selling or trading, but maybe a portion of your portfolio should be set aside for long-term compounders. Right now, I'd say 95% of my portfolio is buy and hold, never touch. And it's very important to research and buy in homework, as Jim Cramer would say. Buy in homework means you buy Microsoft and you continually research the company. You don't do it every day, but you do it enough where, let's look right now at Microsoft. We can see from the annual earnings and estimates, we're looking at this right here, we can see that it's growing at least 10 to 15%, around 10% a year for the next couple years. And Peter Lynch, the person who ran Magellan, probably one of the most successful mutual funds of all time, this is his favorite chart. It's called the earnings against the price of the stock. He liked to buy stocks whenever the stock price goes down, but the earnings continue are not changing. So that means the stock is out of favor, and you still have a stock that's growing 10 to 15% a year. And for instance, this is Microsoft. It's trading at a premium. It always trades at a premium, but there are parts of Microsoft that are growing at 40%, such as their cloud offerings. So let's take another look at compounding. This is what's known as we made this spreadsheet. Let me see if I can okay. It calculates how much you're going to have after a certain number of years. The red is the years, and this is your starting investment. Everything that you can change is in yellow. So let's start off with start off with the year 2022. We put $100,000 in an investment that earns, let's say, 0.115%. we can see if it earns 15%, it multiplies your starting amount by 15. And what do you want to add to it? Let's say we'll add 0 right now. At the end of the year, you'll have 115,000. So if you do that every year, that's 15% times that plus the base, which is 115, and you get $132,000. So now this is important. It's important because if you want to retire, let's say you want to have $1 million by the year 2032. So you have to just do some trial and error. Say if you do a 32% growth, you'll have $1 million by 2030. So you'll have to search out and put your money into stocks that are growing at least 32%. And that's a simple calculator, and that's how compounding stocks grow. Well, in general, they grow their earnings around 32%, let's say. If they do grow their earnings at 32%, there's a very good chance their stock price will go up 32%. So that's why we keep track of the annual earnings estimates of stocks. So whenever we divide the year 2023 by 2024, let's do it for Microsoft. So 1034 divided by 12. So it's growing 15% from this year to next year. And let's do that. I just divided 23 by 24. So you can see, if you keep track of these, then there's a pretty good chance, the bigger cap companies are more reliable. And they have a lot more levers to pull, and they have diversification of income. For instance, Microsoft, it has income from Office 365 subscriptions, from gaming, from cloud revenue. They have a lot of different ways to make money, and now they're actually getting into healthcare. They bought a company that digitizes healthcare records. So a good company always reinvents itself. And this is an example of a company that's down. It's down about 20% this year, but its earnings are still expected to grow around 15%. All right, so let's look at this file, investments. This should be in the files for this week. Now, let's look at the. Hold on. Okay, so I include with every talk a chart of the stocks that we're following. So in the green sections, these are the fields that we use for calculations. So if your share price is 149 for AbbVie, its yield is 3.4, its total value is, let's say 149, okay. Its growth rate is, let's say, it's negative 1.5 right now. But if its growth rate, let's do another one like Google. Google is 114, and the growth rate is 11. So if it grows 11% a year, let's do the calculations. That 149 investment will be worth 155 at the end of 1 year if you have one share. Next year it'll be worth 173. So basically this formula allows you to calculate how much that you'll have in X years, because this goes out 50 years actually. So there's 20, 23, 24, 25, 26. So this goes out a lot of years from now, and it tells you, it calculates how this is compounding with dividends included. So the other calculation here is the yield. So AbbVie gives a 3.4% yield, and it adds that multiplies that times the stock, and that in addition to the growth rate, it actually adds that dividend to it, and tabulates how much you're going to have at the end of the next year. And the hard part is are these growth rates right or not? And you have to, and that's what we do every week. We go back and we say, does that make sense? That growth rate of 16% for Microsoft, is that, we just looked at it right now and it made sense to us. So we're constantly checking these numbers, and this will allow you to really understand quickly, you know, where your money's going to be in 10, 20 years if things stay the same. All right, now let's go back to our notes. All right, so this week this is our calendar, earnings count. This is our calendar, then what to expect. And we knew this week is one of the strongest weeks of the year, because let's look at our calendar. Wait, it's coming up here. There it is. July is one of the best months of the year, primarily because it has earnings at the last week of the month, and that's usually a catalyst for stocks to go up. And in August and September, they're some of the worst months of the year. So we expect pretty much a sideways market to going down for the next couple of months, 2 or 3 months. At the end of the year, we usually have some kind of rally, and that's a seasonal occurrence. It happens for a lot of different reasons. There are repositionings of portfolios. There are pensions that need funded. There are end-of-year allocations that need to be taken care of. So whatever reason that happens, we're expecting it to be better at the end of the year. So you have to keep these things in mind, because you can't get freaked out whenever the stock goes down or the stock market goes down. Okay, so we are overbought right now in the S&P and almost every stock that we're following. You can see the stochastics have reached around 92. That is really high, and we're basically at the top of a channel. Because of that, we expect the S&P to retrace back down to the bottom part of this channel that we have right now. And stocks don't go up forever. Trees don't grow to the sky. We have to consolidate some of our gains. So I expect it to be down probably at least the next week. And because also August and September are bad months. So put all that together, we don't expect a whole lot from next week. We don't have any earnings. We don't have many earnings that will help us in any of the stocks that we're following. All right. So let's review. This is one of the best months best weeks since the year 2020, since the coming out of the pandemic. So right now, inflation is cooling off. We have a lot of the parts of inflation, such as commodities, rolling over. So the CPI has been high, Consumer Price Index, but that's going down, and inflation is not going up as much as before. So that's really good, and we have an employment situation that's really good. That might prevent an official recession, because officials that actually say this is a recession, they look at the employment, and the employment right now is really good. We don't have a lot of unemployment. Right now, a problem is Congress can't pass legislation, and whenever there are laws that are passed and it affects stocks, that is a negative for the stock market, because a lot of times it taxes companies, it makes impediments for profits. So right now there's like a gridlock, and probably thanks to like Joe Manchin in West Virginia, he's helping a lot to be pro-business. So all that being said, let's look at the catalysts that we're following. We're looking for any definitive Fed statements. It seems like from a lot of commentaries that I'm reading, maybe the last or next to last Fed hike will be in September. So if that is true, then that'll be, the stock market right now is maybe going up in anticipation for that. Anything that that you read in the newspaper, such as inflation's getting better, that's already priced into the stock market. So don't even try to go and invest based on what you hear on the TV. Good earnings announcements make the stocks go up, and we had excellent earnings from all of the top stocks that we're following, all the big tech stocks. Microsoft, Apple, Google, Amazon, they all had better than expected, or you can say better than feared. A lot of pundits were saying, well, maybe these stocks wouldn't do so good in this kind of environment, but they're very resilient. So the big stocks, there is power in being a big company because you have power of scale. You have the ability to, these companies that I mentioned there, they have the ability to raise prices, and they have they're really good in this kind of environment for inflation. So any progress with ending the Russian war? Right now we don't have anything. Supply chain bottlenecks, they are getting better. We have a lot of people on earnings reports, such as Ford and Apple, saying that they're handling their commodity price, their supply chain really good, and it's not affecting their products. So now, let me see what else. Okay, 10-year. The 10-year yield is consistently going down. It's gone down a lot in the last 2 weeks. So that is helping the big tech stocks and the stock market in general. Catalyst for the stock market going down. We don't have a whole lot of bad earnings or major things for that. So that's why probably we've had the best week since 2020. Okay, so companies we're going to review. There's pretty much a switch now from, conservative stocks. There was a move from, at the beginning of the year, from high valuation to ones with lower valuations. And now there's actually a flip, and people are trying to buy stocks that are reliable and that that are resilient and that have gone down a lot and have lower PEG ratios. And these companies that people are trying to get right now are the ones with consistent cash flow and rising margins. So Apple said that their profit margin is 42. That is one of the best. Apple is so they're making high profits for everything they sell. So that is really good. So people are for companies that are down 30%, people are running to get into the stocks that are doing good. So, okay, let's look at some of the major variables in the stock market. The crude, this is oil. It's you see, it's up 2 or 3%. It's up a little bit more today. The 10-year Treasury is down. We mentioned that earlier. You see, whenever the Treasury goes down, that means that that's really good for tech stocks and bad for banks. Inflation is still stubbornly high, but it's getting, all the variables that feed into inflation are getting better. So the commodity costs, etc., are getting better. So we expect inflation to actually be down to around 2% by the end of the year. There's a lot of people saying that now. So any company right now that is affected by inflation and has bad earnings because of inflation, keep in mind the end of the year as the time when all that pretty much will hopefully go away. We will see. Okay, let's look at the sector ETFs. Here we go. Sector. Hold on. Okay. The ones doing bad right now, consumer staples. They're probably, this sector is probably down because Procter & Gamble came out with earnings, and they said they met their earnings estimates, but they said the consumer is starting to cut back. So they're buying a cheap version of Tide instead of Tide, and that all happens in a recession, so that might have spooked that sector. Healthcare sector, which was a darling until this time of the year, it's now going out of favor. So that's why we mentioned earlier there's like a switch. There's a switch from some of the more conservative sectors to more aggressive ones because of these great earnings reports this week. So the stocks that are doing good, oil is up 3% today, so anything energy is going to be doing good. And technology and financials. Okay, so that's a good check on that. We like to check on the sectors every once in a while. Last week we, let's see. Okay, last week. Okay, yeah, I already went over the S&P 500. We're basically at the top of the range here of this this chart. So next week we expect to be down at this range. So that's a little bit down from where we are right now. The 10-year is down 6% this week, so it's getting lower. And the fear gauge is still, people are still fearful, but they're less fearful than last week. So people are getting, and you can see from the VIX is 21. That is, people are complacent. Complacency means they are not truly scared. They are not buying protection for their portfolio, and they expect the stock market to go up. So let's see if that happens. All right. So let me see. We're overbought right now, and right now it's not a good time to dollar cost into investments, unless it's we're per stock basis. But right now people are overextended and they bought, and we have to be fearful whenever people are excited. We'll wait for it to go back and for all the stochastics to go down. Okay, we already talked about long-term compounding. Let's talk about some of the long-term compounders that we're following. Okay, so this stock is Apple. You can see that Apple is one of the first stocks to break out of this long-term downtrend since the beginning of the year. So we had a lower highs, lower lows, lower highs, lower lows, and we broke out right here. And we talked about it. It was one of the first ones to break out. And now it's in a process of making higher highs and higher lows. So we're in this chart right here, and we're almost, probably by the end of today, it went up 3% today. So by the end of today, it should be at the top of the range. Next week, it'll probably pull back. And let's watch this channel to see if this gets... Right now, Apple is one of the only stocks that we follow that's over its 200-day moving average. Okay, so 200-day moving average is just a momentum indicator. It tells you what stocks are gaining a price momentum. And whenever a lot of stocks are over that 200-day moving average, that's a good indication the S&P and the rest of the market will be going up instead of a bear market. So let's look at look at some of Apple's earnings estimates. We can see the earnings are going up in a straight line, so it's positive momentum. you can, it's 5%, 5%, 12%. So I divided 2023 by 24, I got 5% earnings growth. 5% for, divide these, and 12%. So I'd say the average is around 6%. So Apple is a total return, it's a growth in income stock. It grows at like 6%, get a little bit less than a 1% dividend. So it's about around 7% total return. So that's an example of a stock that's reliably returning around 7% a year. So if we went back to our calculator and we started with a $100,000 investment in Apple and we made 0.07%. Let me see. 0.07. Okay, at the end of the year we'll have 107,000, and this 7% that it's growing is going to change as it comes out with new products. Apple comes out with a new product line probably every 3 to 6 years. They came out with Apple Watch 3 years ago, and they'll probably come up with an augmented reality headset in a year or two. So this will probably go up as their new product lines come up. But right now, it's they have 1 billion users that are paying service fees, such as backing up their phone to the cloud or paying for video service. So that allows them to have a more reliable income. So innovation is the key to Apple. Every 6 years they come out with something new. They're overvalued right now. They have a PE of 24, and they're only growing around 6 or 7%. So that means they're 4 times overvalued. But great stocks very often trade at a premium. And the average PE for this stock market, or the S&P, is 15 right now, or 16. So having a PE of 24, you really have to have something special and consistent. They're the largest company in the world, and they have more earnings a year than any other company. So that gives them a lot of levers to pull and ways to invest in new products, such as buying companies. All right, let's look at the next compounding company, Alphabet. They've been in a downtrend for at least half a year now, and we noticed a couple weeks ago they started this higher highs, higher lows, and they're right in the middle of this range. So they very well could hit the top of the range, which is here, or the bottom next. We don't know. Well, it's going to be, there's going to be some consolidation in the near future, so it might go down. But there's a very good chance, if this follows this, we're going to have a lot of companies. We're looking at this range right here. This is the 200-day moving average. If Google and a bunch of other major stocks get above the 200-day moving average, that's a good sign we've turned the page from this bear market to a bull market. For me, whenever I'm investing, I know that the lower a stock goes, the better price I get. So as the simple form of investing in this environment, this inflationary Fed raising, I've been following Google in their earnings estimates. Let's go back and look at Google. Let's see, Google. Okay, this is one of the most consistent stocks that we're following. They've been growing at around 14 or 15% a year for a long time. And they're projected right now. I added these numbers up just recently. they're still growing. Let's look at their numbers down here. They're still growing at 13%. So I divided these numbers out here, and so my approach to the this whole environment where we have a bear market, I've been buying Google here, 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 just a little bit as whatever I have to invest, and that was my approach, a simple approach to this environment. I'm actually hoping it goes down lower because Mr. Market, the fictional character from Ben Graham's book, he can present to you a lot of quality stocks at a really low price, and you have to be willing to buy it if he presents that when he knocks on your door. And he's also going to present you something that's really wildly overpriced, and you have to be willing to say no and not buy it. So I'm ready to buy more whenever it goes down. Maybe hope it goes down lower. That's what Warren Buffett says. He'd rather price go down than up. All right, so let's look at the next compounder. Okay, so one more thing. So Google has a PE of 15, and it's growing around 13%. So its PEG ratio is about 1. So it's pretty much fairly valued right now, and it has a lot of cash. So that cash is very useful in this environment. It's not going to need to borrow money, so interest rates have nothing to do with any of the major tech stocks that we're following. So here's some more statistics for Google. Its forward PE is 20, but it has cash. So if you back out the cash, they say the PE is around 15. So the PEG ratio, that means it's 15. Yahoo Finance thinks it's 15% off. It's 0.85. That means it's really inexpensive. And its profit margin is 25. That's a lot better than a 13 or minimum. Return on equity is 30. That's really good. So this is the simplest no-brainer, if you ask me. They have a lot of problems with potential government regulation, but they've been saying that for 20 years. And how do you, we as an investor, you don't. I'm not afraid of that. We just have to be willing to understand that's part of the risk in investing in a stock. Okay, so here's another long-term compounder, Meta. One interesting thing about Meta or Facebook is it is not as consistent and it's not as reliable as the other stocks we're following. So this is that's why I don't have it as a high conviction in my portfolio. Right now it's less than 1% of my portfolio, and the reason is that their platform, they have many billion users. However, their earnings recently went down because of changes that Apple made in their rules for their platform. So Meta is not in total control of their environment like Google or Apple is. So they're reliant on the rules of Apple and the App Store for their revenue. So and you can see from the earnings estimates, they missed more. They missed more than the other companies we're following. So that gives an indication that they're not as reliable, but they are growing at 14, 13, around 14% average when I looked at their statistics. So the PE ratio is 14, and they're growing around 14%. So they're fairly valued. And the great thing about Meta is that you have a company that's really investing in the metaverse, which might be the next big thing. And it might be a lottery ticket because right now it's fairly valued. And if the metaverse takes off, they basically have the operating system for the next internet. we'll see if that happens. Okay, hold on. Okay, Meta's numbers. Right now its PE is 14. PEG ratio is 1. We said that. It's fairly valued. Profit margin, 28. It's a lot like Google, the numbers of Google, 25. So those are all really good. Okay, let's look at, okay. So there was an article that came out, Senate bill takes aim at Visa, MasterCard credit card fees. So right now, Visa and MasterCard, they have around 70% of worldwide credit card market share. Something that's not on this chart is the Visa has a really good portion of the debit fees. So now, the way Visa and MasterCard work is they're like a toll collector. So if you have a $100 transaction, they'll take maybe 0.5% based on the dollar amount. So and that's different for every provider, every merchant, because let's say Walmart can bargain for a better price than a smaller company. But in general, they're trying to take that portion of that toll and maybe even eliminate it, give it to someone else, and make them share. So if that happens, that's not really good for these Visa and MasterCard. But we just have to accept that as one of the risks of owning the stock. And right now, I've owned Visa since its IPO, and MasterCard I own twice as much as Visa because it's growing at 20%. So let's look at MasterCard statistics. Right now, its forward PE is 33, and that's like double the stock market. The S&P is trading at like a 15 or 16, and the reason why they trade a PEG ratio of 1.5. So they're trading at a premium like Apple, and look at their return on equity. That's like 3 or 4 times any other stock we're following, and the profit margin is really good too. Let's look at the chart of MasterCard. They've been trading like a dividend stock has done this year. It's like in a trading range, and right now they're almost at the top of their trading range. So you want to buy a stock like this whenever the stochastics are down to the bottom like this right here, and whenever we're at the bottom of this channel. And that was beginning of July. And so right now it's a little bit it's overbought, but we see. So we can see it's growing. MasterCard is growing its earnings at 19% a year in a straight line. Look at the straight line going up. And let me see. Its PE is 33. So its PEG ratio is around 1.5 to 1.7. So it's trading at a premium, but it's very consistent because they have a consistent. It's not affected by inflation. The reason is inflation. With inflation, the price of things go up. People buy less of it. But when you calculate that, that's the same as people buying at a lower price more. So they basically have the same amount of money in the toll roads. Perhaps in a recession, they will earn less because people don't even buy things as luxury goods and they don't go on vacations. MasterCard earns, and MasterCard and Visa earn a lot from overseas spending, so for vacations overseas, etc. And when there's a recession, people cut back, and they're not going to do that. So let me see. All right. So here's an article. Ford profit rises on higher sales, more inventory. Okay, so Ford's president says, CFO says, we have really strong order banks continuing, significant pent-up demand, and our products are actually selling quickly as we can produce them. We knew for a long time that they have a lot of demand for their trucks and cars and their EV offerings, and they couldn't basically make enough because of the component shortage. And now that that's being resolved. We knew 3 or 4 months ago that they had a solution for this, and probably at the end of this year they'll be making cars at capacity again. So no, this is an example. It's hard to hold a stock whenever everyone's selling it, and there's no hope. Let's look right now. Ford. Let's look at the chart. It's gone up like 15% in the last week or so. It was down to $11 a share. It could go down again to 11. But this is an example of a stock that CFRA says is worth $44 as the fair value. We're always looking at the numbers and making sure that it makes sense for us. Their operating income it tripled from a year ago, but they had some shutdown problems with COVID, and they had a shortage of semiconductor chips. Now there's like an overcapacity of chips, so they reiterated guidance for the full year, and they're raising their dividend. So this is becoming a dividend growth story. They have a really large dividend. Let's look at that. It's pretty big. It's not as big as. Let's look at the summary. It pays a 3% dividend. That is really good. So it's a growth and income stock. So while you're waiting for them to get their act together so they can produce what the demand is, we're collecting a 3% dividend. So so this is an example of it's out of favor right now, but you can see with the chart, it's still down quite a bit. It's still down quite a bit. We might have to wait another year for it to go up to, or a year or two for them to get their components and to be able to make as many cars as there is demand. But the president was very excited about the EV and switch to EV, and he thinks it's bigger than the assembly line that they created in the early 1900s. So, here's another article about Altria. Their earnings beat expectations and it maintains outlook. So, the fact that they beat expectations isn't very important. The most important thing is that they maintained their outlook. That means that they're confident that they're going to earn they're going to continue to grow. And we mentioned last week they raised their prices to meet their estimates, and they have pricing power. So there's a very small amount of cigarette makers, and they have the best brands or the most popular brands. And you can see that they're still growing their earnings over time. They had look at this. This is one of the most consistent earnings charts, that we have, and that's what you want to see in a dividend stock. So right now, Altria. Let's look at Altria. Altria has a dividend of 8.21%. So let's do our quick calculation. Okay, that's 72 divided by 8.21. It'll take us 8.7 years to double our money. That's the rule of 72. The rule of 72 says you divide 72 by the dividend, and that's your return, and that's how long it'll take you to get your money back in the stock. So, but I've already got my money back in Altria. They're always innovating. And they bought Juul, a portion of Juul, the e-cigarette company, and that was a bust. They already wrote off most of that company, meaning it was a bad idea, and they lost money on it. But they're continuing to innovate in the smokeless offerings and other forms of tobacco. So I think that as people stop smoking, there's they'll sell tobacco in another way to people. So they're growing the earnings. I did this calculation. They're growing the earnings at 5% a year. and their dividend yield is 8.7%. So they have a total return of about 13% a year. That's pretty good for a stock that's only growing at 5%. So let's look at the chart of Philip Morris. We like to buy stocks when it has a low stochastics on the less than 20. That was around right here, and right now you can see it's overbought with the rest of the market, but it's still, this is the trading range for Altria, and it's still near the low end of its trading range. So I like to wait for it to get back down here. Right now the whole stock market's up. It'll go back down, so it'll be better to buy it when it's down here. Okay, I'd call Philip Morris, it's not a long-term compounder. It's more of a stock you can buy and hold for a dividend part of your portfolio. So here's another article. Amazon stock soars near 12% after beating revenue expectations. So with Walmart and Target and a lot of those, a lot of the big box in department stores, they said inventory was an issue with inflation, as they tried to order things and people didn't buy them, so they're stuck with inventory and they had to put things on sale, and they thought Amazon would have that same problem. Amazon did have a problem where they ordered more things that they can sell, but they actually beat expectations. So I did the calculations for the annual earnings, and their average growth over the next couple years is 28%. Their PE ratio is 72. That is 5 or 6 times more than the stock market. And it's 2 times overvalued. But Amazon has always sold at a premium to the stock market. For the first 10 years of its existence, they sold at a really high PE ratio, and much pricier, and they didn't have profits for the first 10 years, but they were growing their earnings, not the earnings, they were growing their sales at 50% a year, and now they have earnings, so now they're still given this multiple, they're 2.5 times overvalued. So the lesson learned here is, if they make a misstep or if they miss their earnings, their stock will get crushed. For instance, if they say their projections are they're going to grow 28%, if they say we're not going to grow next year, their stock would go down at least in half, because right now they're selling at this premium because they're growing so fast. And so just like Costco's selling at like a really high PE ratio compared to what they're growing at, but it's consistent and they're consistently growing their earnings. So I like to buy large cap stocks because they're more reliable, and they have a lot of different sources of income, and they have pricing power. And you can see from the earnings, the statistics part of Amazon, that their PE is 72, their PEG ratio is 7. That means they're, let's look at 73 divided by 695. Okay, so Yahoo Finance thinks that Amazon is only growing at 10.5%. So, and they're trading like 7 times more than they should. So it's a really dangerous stock to be in right now in this kind of environment. So they have to hit their numbers every quarter or they're going to get crushed. Because the higher the PEG ratio, the more risky it is to own the stock. So let's look at the profit margin, 4%. That's really not that great. So they don't make a whole lot for every transaction, but they make a lot of transactions. Return on equity is 18. That's really good. So let's look at our valuation or our investors' emotion. Where are we right now? We're probably in the mindset of the investor. We're probably coming back from this bear market, and we're getting to a point where we could have media attention. We're breaking through the 200-day moving averages, and then we're going to be getting up enthusiasm. We're going to get into the well, that's kind of where we're at right now. We're not at despair, but next 2 months are the worst months of the year, so we might end up going back to this despair part. But people are getting a little bit, we're coming back from this big sell-off. So keep in mind, the best time to buy is whenever everyone's in extreme fear and in despair, and there's no hope. And that's why we looked ahead to a next year and the year after, when this thing's going to be over, and what's going to be best to own whenever that recovery happens. And maybe people are still fearful right now. Maybe we're right here. I'm not sure. But if we get above the 200-day moving averages in all the stocks we're following in the S&P, we're going to get some media attention, and people are going to get excited. It's going to be a fear of missing out. And then whenever the whole stock market's going up, you sold off at the bottom, everyone's enthusiastic. We've gotten out of this thing. They're starting to lower interest rates. And then people get greedy and then delusional. That was last year whenever people were buying these SPACs and that kind of thing. So we just have to keep this investor sentiment thing. Whenever the stock market's going down, I like it. I like it so I can get better prices. You know, I only buy a small amount every week or two because that's all I have, but I'll buy stocks at a lower price when they go down. So that's all for that. We mentioned that the average stock market, this is actually, we've been saying that this is one of the best months of the year, and this actually was the best month since the recovery of 2020. It was a really good month. I think it went up the Nasdaq went up a lot this month. So next 2 months is not going to be so good. So temper your emotions, and that's about it. So I think that's all I had to say for today. So thank you all for attending. I hope if you have any questions, let me know, and I'll try to help you out with that. And have a good weekend.